Hi, folks. This is Sean Hyman from the Logical Investor newsletter, and I wanted to talk to you today about shorting and buying puts, and in other words, the other side of the market. So, when we get into positions, we're into buying, which is going long, and you're looking for something to go up or appreciate in value. But one thing I appreciate about your questions on the site is that it gives me ideas of what's rolling around in your head and allows me to address and expound on some things. So I've been getting some questions lately about shorting and about buying puts, particularly on stocks that have gone up and gone parabolic and are grossly overvalued. And the reason, for starters, I don't encourage shorting at all, and here's the reason why. If you short, in shorting, what you're looking for something to do is to go down in value, and that's how your position appreciates in value. I know it's a hard concept for some people to understand, but instead of buying low and selling high, you're selling high and buying low because you cover a short with a buy to flatten it out to zero shares out there. So when you short, you're looking for something to come down in price. But the problem is that how high can a stock go? A stock can go to infinity technically, but it can only go to zero on the downside. So your potential is not really there. Your risk is crazy high because not only do you have to be concerned with in shorting that if you short a stock and in the hopes that it goes down. If you short and it goes up against you for too long, you might get margin called out because you're shorting in a margin account, and so your broker could close those shares out because the price went too far away from you. So you can't just necessarily short something and then if it took 2, 3, 4 years to come about to reap your profit, you can't necessarily make the turn because you might get margin called out and the position closed out on you. But also, there's always the fact that a company can be bought, acquired, all kinds of things that can greatly affect the share price in an instant. So I've seen companies that were overvalued at the time, and let's just say they were trading at $20 a share and a company offers to buy them at $40 a share. Now, they're not buying them for the value of what that company will bring today. They're buying really what that company will do for some years into the future. And in order to entice the heads of those companies and the shareholders out of that stock, you've got to dangle a huge carrot out there in front of them. So you've got to give them something far more than it's presently worth. Even going into potentially what it could be worth in the next couple of years or so. So I have seen cases, even with famous investors, like I watched Dennis Gartman one time get caught in a short like that. He was short a stock that was overvalued. It looked like it should turn down. Fundamentally, it was overvalued, PE too high, etc. He had a right case, but when you're short the stock, you carry unlimited risks. And so in this one instance, one time, it basically increased his risk twofold and took the stock against him. I think it was to the tune of doubling, in the stock, which would have been, doubly against him. And so it was just an enormous hit because he chose to go short the stock. So I never encourage shorting. Now there is a such thing as inverse ETFs that are diversified, and you're going long a product that could have some puts and different things in it. That is okay on occasion when the market is already in a downtrend. So another reason why I'm against shorting is because a put is really a better option because in a put you don't have unlimited risk. You have defined risks. So and forgive me if you're viewing this and you don't understand options. That's okay. So let's just say you buy a put option, and instead of having to pay the full value for the stock price, you buy a put contract, which does have an expiry on it, has an expiration date into the future. But let's say that put contract costs $300, and you're basically betting that the stock goes down in value, and if so, your put option contract will go higher in value, go from 300 to 400 to 500 to 600, etc., and it increases in value as the price goes down. Now, if you're totally wrong and you buy the put and the stock goes to oblivion, it goes to the moon, you have still only lost $300 in that contract. Even if the stock goes from 20 to 40 to 60 before expiry, you've still only lost the same $300 that you put into the contract. So that's why buying a put, which takes advantage of a stock going down, in my opinion, is superior to shorting. Shorting doesn't have an expiration date, but it kind of does, in the sense that you don't get to totally dictate and control when you come out of that position, because it can be it's a margin position, and therefore if it goes too far against you, you can the margin clerks at your brokerage firm can close you out of that to get your account back into the position that it needs to be equity percentage wise. So so that's why puts are better than shorting. Okay, now with that said, I don't encourage put buying when a move is parabolic, and the reason is because theoretically, what should ideally happen is the stock turns into an upside down V, where it goes up, parabolic move, and then turns around and comes back down in a parabolic move downward. So picture a V and turn it upside down. That's the ideal scenario. But the problem is that sometimes you get stocks that stay overvalued for quite some time. Tesla is one of them. This stock, goes from down here at 2025 a share and goes up to 265 a share, and even a little higher later on. Now, wouldn't you say that's pretty far fetched in a short amount of time? For about a year, it goes from 2025 to 265. Okay, so let's say you buy a put here for a year out. Well, it dips some for you for a little bit, and if you structured the put right, being at the money, you might come out of that just fine. But if it's out of the money, or you didn't see the dip, then it comes up and sustains itself, not only where you bought the put, but even higher. And before it goes back down again, and it still doesn't go materially down. Really, it doesn't go any lower than this, and then goes back up again, and then finally goes down materially lower, where you could cash out with a really nice gain. So that could be my point is that could be a year or two in the making. And if you have bought a leap contract, let's say for a year out, which is just a long-term option, or if you bought a put for 60 or 90 or 120 days, if you bought the shorter 30, 60, 90, 120 day put contracts trying to catch a top, most of the time you're not going to come out, because even if the stock falls, a lot of times it's going to do it towards the end of the contract, and the end of the contract, the time factor, the time value of it is eroding away the price of the contract so fast that it's possible for the stock to go down and for your contract really not to increase hardly at all in price. So that's another facet. You can help counteract against that by going out further in time. But again, there are times where stocks can stay overvalued and even go higher for a long length of time. So there are times where something could stay overvalued for a year or two. And by the way, what happens if if this went from 20 and you bought the put at 50 or 75 or 100 or 150, then I mean, it wouldn't even be, you couldn't even have a 3 or 4 year put that would be profitable, even though the stock is grossly overvalued. And I think that's even probably a better example. But the point being is that something can stay overvalued for a long period of time. And this is not a typical case, but it happens enough to where it's just really not the way to play it. Another one that went up for a good while, that took a while to come down, was when biotech stocks got on a tear, and IBB, which is a biotech ETF, went from the 20s to 40s to 90s to 130s before it ever came down. And so trying to catch the top on a parabolic move, it can seem like, well, it's already gone up so much and so much more than it normally does historically, so I'll just buy a put on it. But the thing is like, I'm sure if you saw this go from 24 to right at 50 in such a short amount of time, that could have easily been a put buying opportunity for you. Or when you saw it go from, 20s to 90, that could have been a put buying opportunity for you. And granted, there was this little blip right here for sure, which could have been enough to do it. But if you don't catch that right there, this thing goes against you so far and for so long and doesn't come back to that area for, again, a couple of years, and you're still only at the place where you started. And if this one little blip hadn't happened, all the rest of the activity that happened for the next couple of years is still at that price or higher. So trying to short or buy a put on a parabolic move upward is not what I would suggest people doing. So, and I'm going to show you what I do suggest here in just a second as well. AMD is another one right now that the stock is in. There are so many bubble-like stocks out there right now. This is another reason why I can tell you we're towards the end of a bull market, because there's such froth out there. There's such recklessness. People are not scared at all to bid stocks up. And when that happens, it's towards the latter stages of the bull market when people are the most lazy, the most frivolous, with their money, and there's no fear within them because they're totally consumed by greed. And so I mean, it's Facebook, it's Amazon, it's Netflix, it's Google, it's Microsoft, it's Cisco, it's Intel, I can just go on and on and on and on, all these bubble stocks, and it's tech stocks, it's pot stocks, which I want to invest in. It's all kinds of stocks that are out there right now that are in these bubbles, and trying to call a top on them is a dangerous thing because of what I just showed you. So we're just seeing this one here, and it would seem like this is the top on it, and it could be. But it's why when something gets away and goes crazy like that, I encourage people to exit their long positions, because of the downside risk versus the potential for upside reward gets typically out of whack. Now, we don't ultimately know the upside, but we know, if you invest in stocks long enough and something goes crazy like this away from its 50-week and 200-week moving averages, chances are it doesn't hold, and your downside risks we know are huge no matter what. So, risk means that it doesn't have to happen, but it means it's likely to happen. So, so you run the risk of giving back all or part of your profits. So that's why I encourage people to exit their longs, exit their buys when these parabolic moves happen. But what it does not mean is to short the stock or to buy put on the stock, because of what I've shown you earlier. All right, so now let's look at a stock that I've shown before. That the reason why I'm showing it is because it's in a bubble now, and this is Weight Watchers. It's in a bubble now, and it's been in a bubble before within the last 10-year period. So it's an easy one where you can see two bubbles all on the same chart, which is why I picked it. And so, here it's down at $20 a share, and here it's at 80, 84 a share, and it just ramps up and runs up in a fairly short amount of time. So here's what I would suggest doing. And again, this is just to give you an idea of the better times to short. Again, they're not short, excuse me, better times to buy a put. So I never suggest shorting. I suggest put buying for those who are inclined to want to take advantage of stocks on the downside. But here's when I suggest doing it. I suggest doing it when the trend has already turned downward, which means the 50-week moving average has turned downward, and the price is trading below that 50-week moving average, and the price has a bear market bounce up to the top of what's called a Bollinger Band. That's these green lines on the top and the bottom. So it's a way of gauging volatility and when something is somewhat overbought or oversold right in the price action. And so for more on Bollinger Bands, you can go to investopedia.com. So it's investopedia.com, and put in Bollinger Bands. It's from a guy named John Bollinger, Bollinger. And when this is in a downtrend according to the 50-week moving average, and the price has bounced up to the top Bollinger Band, that is statistically a better time to be buying a put because the momentum has already shifted from up to down. And people go, well, yeah, but I hadn't, called the top, and I could have gotten in at the top up here. That's true, but the assumption is that you knew that this was the top. This could have easily gone 80 to 100, 150, 200, 250, etc. So, when this is rolled over and the price has gone below it and the 50-week moving average is declining and the price has come back to around the area of the 50-week moving average and the top of the Bollinger Band, that's a great place to buy your put. And the nice thing about that is that you have plenty of opportunities typically within that. So here's one of them here, and it dives off and goes far away from that 50-week moving average into the Bollinger Band. So you would certainly want to be out of it by then. It does it again right in here. And so you get another drop lower, which you could have got out here or here. This one, obviously, the sooner the better because it goes to the bottom band. Then it happens again right in this area. That it's still a huge decline. It does come above the 50-week moving average, but the 50-week moving average is still heading lower, and it's at the top Bollinger Band, and so it sells off and has huge moves again. So there's a lot of opportunity here. This is, whatever, 60 or so, and then it falls to 45, and then this is, 50 or something like that, and falls to 25. And of course, you may be out from 50 to 40, but still that's a huge move in such a short amount of time. Here you're just shy of 30, and it ultimately goes to like 3, and obviously you would be out far sooner than that, but it shows the potential. Even if you were in at 2025 and it drops to 10, I mean you've made a huge move there, and so that happens for quite some time, and even when it rallies up here close to the 200-week moving average, which is also declining. It still is unlikely to surpass that 200-week moving average the first time. So even once it has this massive jolt, the 50-week is still moving down, the 200-week is moving down, so you get this other opportunity back here at 27, 28 again, and then it goes back to the 50, at $10 again. So there's all kinds of opportunities and a lot of money that can be made over years sometimes. In stocks, buying puts in the downtrend. So this was, like a few years worth of opportunities, and 1, 2, 3, 4 major opportunities within those few years, and massive gains that could happen as these downdrafts happen. So I don't encourage you to short a strong uptrend. And I don't encourage you to short at all. But if you are going to do put buying, I would encourage you to do it when the trend is down and it's rallied up to the 50 or 200-week moving average, and also it's at the top of the Bollinger Band. So those are the criteria for doing that. So Weight Watchers is a good example of that. Here's another one where pizza places. I mean, pizza places shouldn't really, run up to crazy heights from 12s all the way up to 88 over a handful of years. But when it finally turns down, there's opportunities that this is in now. You've got you could have done one here possibly, but it's for sure more definitive in the downtrend here. So right here in the high 60s, and then it falls to 55 or so, and here's another one right here where it's at, I don't know, say 65, and it falls to 50. Or just a couple of opportunities for sure that have already happened in this one, and there'll probably be another time within this downtrend where it happens again. So there are opportunities, and this is PZZA, which was Papa John's, where there's those opportunities. Another one was another pizza outfit that is in the upside now and hasn't experienced the downside yet. So it's one that, again, if you are a put buyer and you're looking to have that shorting like opportunity but with limited risk, then you buy puts, but you don't do it now. You wait till the price goes below the 50 week, and the 50 week is curved and turned down, and that's going to take some time. So it's not going to happen likely tomorrow. But once it's in that downtrend, you've probably got quite a bit of downtrend that happens in price, because this was a very long move from the 20s to 300s, and so it could easily cut in half from 300 to these usually, when they get this far stretched, go well below the 200 week moving average. So I mean, it could go to 120, 100, 140, anything like that. So it can more than cut in half. So there will be plenty of dollars that could be made in buying the puts on the downtrend once that does happen. Another one was CMG, and this one had run up and gone crazy from 70s to 442 here, and really this one. This one kind of mildly turned downward here because it still really had more long-term uptrend to go. So you had one decent put buying opportunity here at 400s down to like 300, and then it takes off in another uptrend again. So the 50 week is heading higher. So you don't be shorting or put buying there. And I keep saying shorting, but I mean put buying. And then it turns down here. And then when we finally get this more distinct downturn here versus this more mild one here, you get opportunities that start to emerge. You draw those. So you've got one here, which is close to the Bollinger Band and top side of it, and it's moving downward there. It's also, you could catch it when it was, bumping its head up against the 200 week moving average as it starts to fail there. And it's best to really catch these on their bounce up rather than their move back down, because as the price bounces up, the put premium is shrinking big time. And if you're trying to wait for it to go down, the put premium is expanding quite a bit already. So it's best to catch these coils up, ideally towards the top of the band. So here's another couple of opportunities here. Here's another opportunity here. It doesn't go down a whole lot, so you'd probably make a little bit, or that one be worthless. You got two here that were profitable. It comes up to the top band near the 200 week moving average, which again the price is below it. And so it's into the top band. So you get here in the 490s, and it ultimately goes to close to 250. So lots of opportunity in there. Obviously, people wouldn't write it all the way down and know for sure where that bottom was, but it shows the potential there. I mean, even if it goes from year 500 to 400 to 300, you made a lot on that. And then, so that's just some examples of higher probability ways to enter puts. So if you've read my book, my option trading book, Option Trading Demystified, that one focuses on calls and call buying in an up market, and it gives the rules there. It gives you 6 different strategies. All you have to do is reverse those rules, and you're getting what I'm showing you today. So if you've never checked that out, check out Option Trading Demystified. You can get it. You can just Google it, and you'll find it in every ebook format. It's at Amazon in Kindle format, etc. So SKX is the last one I'm going to show you today. Skechers, again, just shoe company, but it goes from 7 and 11 up to 54 before it's all said and done. This one does do the upside down V, like many times happens. But again, I showed you plenty of instances where that it stayed overvalued for years and would have eroded away your put option to zero before what you thought would happen should happen. So again, wait till it comes down, it curves down, and then you've got an opportunity. Potentially you have one here. You for sure have one here. You for sure have one here and here. And then it's still down here. So I mean, you could get by with this one and coming back down to here. It starts to turn back up here. So that's when you get away from it again. And since this has come down and is hovering around here, this could end up curving down again and give it some more rounds of put buying. So the point is that you really want to be buying the puts in the direction of the trend, but you want to be taking those counter trend moves. So a counter trend move in a downtrend is a bounce higher, a bear market bounce higher. So this is with the trend, this is against the trend, this is with the trend, etc. So the bear market bounces up to the top of the Bollinger Band with a declining 50-week moving average, and also at times later on, in some cases, you'll get a declining 200-week moving average. Either one of those is sufficient, but one of those needs to be turned down. If it can be one or both. But the point being is that will denote the trend, and then you just want bear market bounces up to that 50-week and up to the top of the Bollinger Band. Those are your higher probability trades in that. And these are trades. They're not investments. They're something that you are really looking to be in days, weeks, or months. So they're not investments of of something that you're going to be in 100% of the time for years, typically, because that would be taking on typically too much risk, because you never know how far these things are going to go down before they turn back up and go higher again. So when you have decent profits in options, you need to take them, because usually big profits in options that aren't taken tend to erode away. Now, one thing you can do to lessen risks, of course, are if you are in a move and you've made quite a bit and you think it's still got more to go, you can always sell half your put contracts and leave half on, or sell 2/3, leave 1/3 on. I mean, there's ways that you can give yourself opportunity to still have something in the market. But most of the time, when I've had large profits in something on a put or a call, I tend to capture it all, because I don't want to give back any of those profits. I want to keep 100% of it, and I don't worry about if there was more that could potentially be had. So that's the way I choose to look at that. Anyway, so I hope this has helped you, whether you're into options or not, or puts or calls or not, or whatever. Just the fact of how to deal with down markets and how to view things in down markets, I think will help anybody, whether you ever get into options or anything like that at all. I just think that will be helpful for a lot of people to kind of grasp when it's better time to be dealing with down markets and when it's riskier to be dealing with trying to catch a top. Okay, thanks so much for watching, and God bless. Bye-bye.